Hello, everyone. Welcome back to FinancePath. Recently, the Federal Reserve's M2 money supply data shows that the M2 money supply climbed to a record of $22 trillion in April 2025. Does this mean that the stock market will surely rally? No, I don't think so. Recently, on the website, videos and relevant articles began advocating that the stock market and other asset values will shoot up due to the record money supply. I agree that a larger money supply can increase the amount of capital in the market, and therefore, there is a potential that money can be thrown into these assets, including the stock market, and then push the value of these assets up. Although this may happen, it may not be certain to occur, as there is no proven link to indicate that the increase in money supply will surely cause the stock market to skyrocket. The chart shows that the money supply has a positive correlation to some extent, but it is obvious that this is not always the case. The chart shows that in general, the M2 money supply goes up, but the stock market doesn't rally in alignment with it. From the chart, the S&P between 2000 and 2003 went downward, but the M2 money supply still increased. Today, we're exploring the most talked about force behind the soaring stock market, the money supply. Is the record-breaking surge in M2 the reason stocks are climbing? Or is something deeper driving this bull run? Before we begin discussing the topic, it is necessary to be clear about M2. M2 is a broad measure of the money circulating in the U.S. economy. It includes M1 and slightly less liquid assets. M1 includes the forms of money that are most easily spent. It's often called narrow money. It consists of physical currency, which is coins and paper money in circulation, demand deposits, which are money in checking accounts that can be withdrawn anytime, traveler's checks, and other checkable deposits. M2 factors everything within M1 and adds money market accounts, savings accounts, and certificates of deposit CDs below $100,000. This is still money consumers can spend, but it requires more effort to get to. Normally, the M2 chart slopes up and to the right. This means that as the U.S. economy has grown over time, the money supply has also increased, reflecting the need for more cash in circulation to facilitate transactions. When M2 rises, it often signals that more money is available in the financial system, more liquidity, spending power, and potentially more fuel for asset prices. However, if the money supply outpaces economic growth or product output, this can cause high inflation. High inflation may prevent economic development, and the stock market may decrease. The chart shows that the U.S. M2 money supply seems to have a positive correlation with stock market growth. This happened after the great financial crisis between 2008 and 2009 and again during COVID-19 in 2020 and 2021. However, the chart also shows other cases. So, here's the key question. Is that money supply increase really causing the stock market to soar, or is there something else going on? Due to the seemingly positive correlation between the money supply and the stock market, many argue that the historical increase in M2 will drive the stock market's rally this time in 2025. They claim we're in a melt-up, and every dip is a buying opportunity, because more money printing means higher asset prices. But that's not the whole picture. Yes, more money in the system can potentially boost asset prices if that money mostly flows into stocks. However, not all M2 expansions translate directly into stock market gains. The increased money supply is often stored in savings and used to pay down debt. In addition, the growing money supply could substantially impact inflation, which has been a headache for the U.S. economy since 2022. While the Fed has made progress on its goal to lower inflation to its preferred 2% target, the number is still closer to 3%. Rebounding inflation would also likely be very bad for the economy and stock market because it could start to raise concerns about stagflation, where the labor market deteriorates and prices stay elevated, resulting in anemic economic growth. If the U.S. economy really enters the status of stagflation due to the money supply in combination with other factors, it can be imagined that the stock market will necessarily go downward instead of experiencing a melt-up. In fact, Fed Chair Jerome Powell indicated that the correlation between M2 and the stock market isn't always strong. Stock prices, ultimately, follow corporate earnings and economic output, not just liquidity. So, if we want to understand where stocks are heading, we need to look at the real engine, economic growth. The real engine behind the stock market surge is not the M2 money supply, but whether it can reach a certain point and contribute to economic growth. When the money supply expands and stimulates consumer and business spending, it can increase corporate revenues, boost hiring, and drive GDP growth. And that's what pushes stock prices up sustainably. Take the 1980s, for example. Specifically, before 2020, the largest yearly increase in M2 was 12.6% in the second quarter of 1983. Over the following 18 months, the average year-over-year growth in real gross domestic product GDP was 7.1%. The S&P 500's average annual return is approximately 10%. During the COVID-19 pandemic, the U.S. money supply expanded by more than 26% year-over-year at the height of the pandemic. The increase in the money supply, combined with other fiscal measures, helped to bring the economy back and recover the stock market. So, rather than thinking money printing equals stocks up, a better framework is rising M2 increases liquidity, pushes higher spending, produces a stronger economy, and converts to stock market growth. This is just a theoretical pattern. Other factors also play significant roles in whether or when the stock market can finally rally. So, even though the M2 money supply may have a positive correlation with the stock market to some extent, that doesn't mean that the increase in money supply can cause or mean the stock market to rally. In this situation, the M2 measure can only be used as one of your indicators to monitor whether or when to buy in or sell your investment portfolio. But it can't be used as the determining factor for your investment portfolio. In June 2023, Bespoke Investment Group published a dataset after comparing the calendar day length of every S&P 500 bull and bear market, dating back to the start of the Great Depression in December 1929. The data shows that the average bear market is 286 calendar days, or less than 10 months, while bull markets average nearly 3 years. Further, looking at the S&P chart, we can see that despite short-term volatility corrections, bear markets, and political headlines, the chart shows that downturns can always be overcome. This means that investors who stay calm, buy the dip, and think long-term tend to come out ahead and make a gain. The stock market chart tells us that the U.S. economy is always on the way to growing. Even though it sometimes has a recession, the U.S. long-term real economic growth guarantees a sustainable stock market rally. So yes, buy the dip, but not because they'll print money forever. Buy it because strong fundamentals and liquidity are aligning to support future growth. So, even when buying dip, it will be better to make a wise decision by considering other economic factors, such as inflation, employment, etc. You should also pay attention to the bull and bear calendar day length to help you decide when it is a good time to enter and exit the market. This doesn't mean everything is smooth sailing. Rising M2 also brings risks, most notably inflation. If inflation rebounds and stays above the Fed's 2% target, the Fed could be forced to raise rates again, choking off growth. And let's not forget fiscal pressures. With ballooning national debt and trade tensions heating up again, there's still plenty that could go wrong. So, while U.S. economic fundamentals are on the way to growing now, you should still diversify your investments, avoid overpriced stocks, and stay grounded. We are in a fascinating moment. The M2 money supply is exploding, and U.S. economic history shows that such growth typically fuels economic expansion. Thanks to more advanced financial knowledge and economic management tools, economic growth, in turn, drives higher corporate earnings and stock prices. So, it's not just the money supply that pushes stocks up, it's how the money enables a stronger economy that drives the stock market up. If you're an investor wondering what to do, here's the takeaway. Don't panic during corrections. Use downturns as buying opportunities. Focus on economic fundamentals and quality assets. Invest for the long run, and make good use of the market calendar date window for entering and exiting the market. When you combine liquidity with growth, you can have the recipe for future gains. That's it for today's video. Please like, subscribe, and turn on notifications if you found this helpful. Thanks for watching FinancePath. See you at the next one.